Welcome back in to ClearPath Retirement Radio. I am Stuart Smith. I'm here with Mitch Davies, my co-host, and we are ready for the segment we do every week called Mitch's Market Minute, and we are ready. Mitch, let's talk.
I'm excited, Stuart. As always, this is my favorite segment, personally. We've got a ton going on in the markets these days, and it's nice to just spend a minute talking about what's going on, the kind of stuff we're telling clients every day. We're trying to, again, we're retirement planners, so we're focused on helping make sure that people are navigating through that phase of life correctly. And a lot of that, especially in times like this, is just talking people through, hey, there's a lot going on, but what does that realistically and historically look like? Because a huge part of our job is to understand the history of the markets and understand that how things like this impact the market. So let's spend a minute talking. First, as we always do, we're going to start at where we're at overall. The S&P still a bit down from all-time highs. We're sitting at right around 6,500. The Nasdaq right at about 21,006. So both of those are about 6 or 7% down from all-time highs, which we hit at the beginning of the year. And a lot of that has to do with oil. We talk about it every week, but it's the most important thing right now is oil prices are elevated. That Strait of Hormuz over there, just south of Iran, is still closed, and seems like things are working through that. We're probably getting closer to that getting opened. It seems like more NATO countries are starting to shift focus into that, and hopefully that gets open and oil prices are able to get back down. I know you've probably been driving by the gas station and seen, at least here, we're seeing $3.70 for, a gallon of gas, which is much higher than it was 3 months ago. So, and what we've seen is when things like this happen, oil prices and the stock market trade inverse. Generally, there's not much correlation there. Generally, we look at assets and how they're correlated. And what that means is when one goes up, the other one goes down. And oil generally doesn't have much correlation to the market. But in times like this, when the Middle East area has a huge production area for oil. And when there's straits being blocked off and energy centers being attacked, a lot of things going on, it tends to be a negative correlation to the stock market. And that's what we're seeing. So when we see oil prices rise from 60 a barrel to, they eclipsed over 110, 120 a barrel, we see the stock market take a hit. And what that means is volatility is higher. What that means for you is that when these things are happening and people are worried about the price of oil, they start selling off assets. Now, I want to spend a minute talking about what does this look like historically? Like I said, a huge part of our job is to understand the stock market history. And, patterns in the stock market and political tension and these things we have a lot of data. We have a lot of history on since the stock market's open, we've seen world wars, we've seen pandemics, we've seen things that have really, really escalated into dramatic fashions, and we're able to go back and study what that means. And, the first thing I want to talk about is the S&P 500. Everybody knows what this is. Super simple. It's 500 companies that are handpicked to represent the market overall throughout different sectors of the economy. And a huge indicator, we look at charts, we look at stock charts, and a huge thing we look at is if you look at the weekly chart on the S&P, and you look at the 200-day moving average. This is just an average price over 200 days. And when the weekly chart on the S&P crosses under the 200-day moving average, historically that's an extremely good sign. It's an extremely good buying opportunity. And what that means is we're seeing a lot of great companies go trading at a cheaper price, is really all that means. And every time that's happened, interesting history on that is, on average, in the next 6 to 12 months, after we see that crossover, which we're seeing now, we've only seen 5 times in the last 25 years. We've seen, in the next 6 to 12 months, we've seen a 6 to 8% return. In 12 months after that time, we've seen 10 to 15% returns. The last time we saw this was last year when the Liberation Day tariffs were announced. And from the bottom in April to 2 months out from there, we saw 30% gain on the S&P. So what that tells us is it's an extremely, a huge gain. And what that tells us is these reactions are often V-shaped recoveries, right? We see dramatic headlines, we see heightened fear, but then the second it gets resolved, whatever it is, and in this case, it's conflict in the Middle East, we see a huge influx of buyers because historically, especially the U.S. markets have dominated, especially over the last 25 years. Returns in U.S. stocks have been so substantial that the second these things resolve, we see influx of buying come really into the market. So what that means for you and what that means in retirement is if you're working with us, for example, and you're allocated safely ahead of time, you understand that there's going to be a little bit of fluctuation, but you're not freaking out because you understand that we have the history to say that when we see these dramatic dips, it often recovers really quickly. And what we're telling clients all the time right now, it's extremely important in times like this, is, hey, there is a lot of volatility and the dips feel violent, right? We're really only down 7 or 8% on the S&P for the year, which isn't anything insane. We saw that for an entire year and a half in 2022 going into 2023. We were down 15%. But when there's big headlines, when there's news events, it feels so dramatic. And you get on the news and you see the breaking news, and then you look at your portfolio and it's down, and it's like, oh my, it feels so heavy. But what we've seen is these events are great buying opportunities, and we see really quality companies selling at good prices. So what I would challenge you to do is look at your allocations. You want to be in retirement. This is why we always talk about the bucket strategy. We always come back to the 3 bucket strategy. If your retirement income portfolio is set up correctly, you've got a buffer of money to live off of for the next few years that isn't affected by the market. You're not going to worry too much when these events happen. So that's always the way we come back to how we structure retirement income in general, is those 3 different strategies. And so I would challenge you to take a look at your portfolio. And if you're just 100%, if you're in retirement and you're 100% just invested in the S&P 500 and you don't have a strategy, you don't have a clear bucketed plan, you're going to feel more fear. It's going to feel more heavy. So I would challenge you to take a look at that. And if you have never taken a look at a different structure, give us a call.